Imagine you wake up one morning and someone has taken money from your bank account. No notification, no transaction history, no one to call. The number on your screen is exactly the same as it was yesterday, but what it can buy, quietly, invisibly, is less. That's not a hypothetical. That's happened multiple times in multiple countries, and it's happening right now. It doesn't have a warning label. It doesn't require a vote in parliament, and the people doing it don't call it stealing. They call it monetary policy. Today, we're talking about inflation, but not the way you've heard it explained before. Not the textbook version about supply and demand. We're talking about inflation as a deliberate instrument of government finance, a mechanism that transfers wealth from ordinary people to the state, quietly, legally, and with almost no political cost. This is the invisible tax. Let's start with something most people never question.
When a government spends more money than it collects in taxes, it has a problem. It has a deficit, and it needs to fill that gap somehow. Historically, governments have three options. They can raise taxes, they can borrow money, or they can create new money. Raising taxes is politically painful. You announce it, people get angry, you might lose an election. Borrowing works for a while, but debt compounds. Eventually, the interest alone becomes a problem. So over the long arc of history, governments keep coming back to option 3. Not because it's honest, because it's quiet. Creating new money sounds like magic, and in a way, it is, except the trick only works once, and someone else always pays for it. Here's the mechanism. When a government needs money and can't or won't raise taxes, it instructs its central bank to purchase government bonds. The central bank creates the money to do this, digitally, from nothing. The government now has cash. The central bank holds a bond. And somewhere in the background, the total supply of money in the economy has just increased. More money chasing the same amount of goods. That's the seed of inflation. And here's the part that matters. That new money, when it first enters the economy, has full purchasing power. The government spends it on salaries, contracts, services. The people receiving it spend it before prices have adjusted. For a brief window, the new money works as advertised.
But then the price signals start moving. Slowly at first, then faster. And by the time ordinary people feel it, at the grocery store, at the petrol pump, in their rent, the transfer has already happened. The government got full value. The public got diluted currency. That lag is not accidental. That lag is the entire mechanism. The economist John Maynard Keynes described this in 1919. He wrote that through a continuing process of inflation, governments can confiscate, secretly and unobserved, an important part of the wealth of their citizens. Secretly and unobserved. He wrote that in 1919, a century ago. The mechanics haven't changed. What has changed is the scale. Let's look at some numbers to make this real. In 2020, the United States Federal Reserve expanded its balance sheet by roughly $3.5 trillion in a matter of months. Not years, months. The total money supply, measured by what economists call M2, grew by nearly 27% in a single year. That is not a normal fluctuation. That is a shock to the system. Now, some of that was necessary. A global pandemic had frozen the economy. Unemployment spiked, businesses were closing. There's a legitimate argument that emergency intervention was required. But here's the part that gets quietly glossed over. That money had to go somewhere, and it did. Asset prices surged. Stock markets recovered and then exceeded pre-pandemic highs within months. Real estate prices jumped in cities across the world. Anyone who owned assets, stocks, property, anything with a balance sheet, watched their net worth climb, sometimes dramatically. Anyone who didn't own assets watched the price of everything they needed to buy go up. That is not a coincidence. That is redistribution. It just moved in the wrong direction for the people least able to absorb it. There's a concept in economics called the Cantillon effect. It's not taught in most schools. It doesn't come up on financial news panels very often, but it might be one of the most important ideas for understanding why the modern economy feels rigged. Richard Cantillon was an 18th century economist, Irish-French, and remarkably ahead of his time. His core insight was this: when new money enters an economy, it doesn't affect everyone equally. It affects people differently depending on how close they are to the source. The people who get the new money first, governments, banks, large institutions, well-connected borrowers, spend it before prices adjust.
They get full purchasing power. By the time that money works its way down through the economy and reaches ordinary workers, prices have already risen. Those workers receive the same number in their paycheck, but they're spending it in a more expensive world. The proximity to the money printer determines whether inflation helps you or hurts you. This is why in almost every major inflationary episode since the Second World War, asset owners have come out ahead and wage earners have fallen behind. Not because of individual effort or merit, because of structural position in the money flow. It's a quiet, elegant, devastating mechanism. Now, let's talk about debt, because this is where the invisible tax really earns its name. Governments that borrow heavily have a serious long-term problem. They owe money that needs to be paid back in real terms. A country with $10 trillion in debt is on the hook for $10 trillion of future purchasing power. That's a staggering obligation, unless it inflates. If a government can sustain even modest inflation over a long enough period, the real value of its outstanding debt shrinks. Think about it this way. If you borrow $1 million today and inflation runs at 6% annually, in 12 years, the real value of what you owe has roughly halved. You still owe $1 million, but $1 million buys much less. Your creditors get paid back in depreciated currency. This isn't just theory. After the Second World War, the United States and the United Kingdom both carried debt to GDP ratios that would be considered catastrophic by today's standards. The UK's debt to GDP peaked at over 250%. Instead of defaulting, instead of brutal austerity that would have collapsed the economy, both countries allowed sustained inflation across the late 1940s and into the 1950s to gradually erode the real debt burden. They didn't announce this as policy. They didn't hold a press conference to say, we are going to dilute the savings of every citizen to make the debt math work. They just kept rates low, let prices run, and watched the debt to GDP ratio decline over decades. It worked, and they did it again, and the institutional memory of it never quite went away. Here's the uncomfortable part that rarely gets said directly. Inflation doesn't just destroy purchasing power, it specifically punishes savers. People who work, spend less than they earn, and try to build a buffer, those people are actively penalized by inflation. Their savings erode. Their future purchasing power is confiscated incrementally, year after year, without a single line on a tax form. Meanwhile, people who hold debt, particularly fixed-rate debt on real assets, benefit. Their debt becomes cheaper in real terms, while the asset they borrowed to buy may appreciate. This is why the financially sophisticated consistently advocate for being a borrower in an inflationary environment. Not because debt is smart in isolation, because inflation systematically rewards debtors and punishes savers. Think about who holds most of the debt in a modern economy. Governments, large corporations, real estate investors. Think about who holds most of the savings. Middle-income workers, people nearing retirement, people who followed the conventional advice. Work hard, save, don't take on excessive risk. Inflation doesn't just redistribute wealth arbitrarily, it redistributes it in a very specific direction, and the people designing monetary policy are not in the category that gets hurt. There is a counterargument worth acknowledging. Central banks are not cartoon villains. The people running the Federal Reserve, the European Central Bank, the Bank of England, they are not sitting in rooms plotting to steal from pensioners. In many cases, they're trying to navigate genuinely impossible trade-offs. Letting inflation run can erode savings, but deflation, falling prices, can be catastrophic, destroying investment incentives and collapsing entire industries. The 1930s are a standing reminder of what happens when the money supply contracts violently. And modern central banks do have mandates, targets, and at least some degree of accountability. But accountability and transparency are not the same thing. And there's a difference between using inflation as an emergency tool versus relying on it as a chronic subsidy for fiscal irresponsibility. The problem isn't that governments sometimes need to create money. The problem is when that mechanism becomes the default solution every time the political cost of honest choices gets too high. When the interest on government debt becomes too large to manage, when tax increases are politically impossible, when structural reform is too slow for an election cycle. The printing press is always there, clean, quiet, with no one's name on the bill. So where does this leave us right now? The inflationary episode that began in 2021 and ran hard through 2022 and 2023 was remarkable not just for its speed, but for the public response to it. People noticed, not in an academic sense, they felt it. In food prices, in housing costs, in energy bills that suddenly represented a significant portion of a monthly budget. The political fallout was real and continues to reverberate. But what happens next is the question that doesn't have a clean answer. Global debt levels, government debt across major economies, are at or near historical highs relative to GDP. Interest rates, after being suppressed for more than a decade, rose sharply and are now a genuine fiscal burden in a way they weren't when rates were close to zero. The U.S. government alone is spending more on interest payments than it spends on its entire defense budget. The options haven't changed. Tax more, borrow more, or inflate the problem away. Two of those three options have a ceiling. The third one has a very long runway.
Here's the thought that tends to sit uncomfortably with people once they see it clearly. The money in your bank account is not a neutral store of value. It is a claim on purchasing power inside a system where the rules of that system are managed by institutions with their own balance sheets, their own obligations, and their own survival instincts. Your savings are one policy decision away from being worth meaningfully less, not through theft in any conventional sense, through a percentage point here, a quantitative easing program there, a decade of rates held just low enough to make the debt math work. No one will break into your account. The number will stay exactly the same. It's everything the number can buy that quietly changes. The invisible tax doesn't announce itself. It doesn't ask for your consent. It has no return address. And the most unsettling part? The people who understand how it works have already made sure they're on the right side of it. The question is, have you?